Canadian Pacific reported their earnings yesterday, but are they now a strong, undervalued company that we need in our portfolio? We're going to take a look at the historical performance of the company. We're going to look at their revenue growth, top line, as well as bottom line net income year on year. We'll analyze their balance sheet, a quick health check, total cash versus total debt. We'll see how they've performed versus some of their competitors over the last 5 years. We'll also touch upon that all-important dividend safety, as well as looking at some strong financial metrics. We'll see what institutions have been doing quarter on quarter over the last year, and we'll see whether or not there is any insider buying or selling to discuss. And more importantly, we will touch upon their earnings. How did they perform versus Wall Street analysts? Or did they beat, or were there any misses? And as always, we will run them through the valuation model, getting to the intrinsic value as well as getting to our acceptable buy price, given that investor margin of safety, and we'll look towards Wall Street to see what price they forecast over the next 12 months. So let's start off with their earnings to see how well or how poorly they did perform. And when we take a look, we can see for the quarter ended December 2023, they reported revenue of $2.77 billion. Now this is up 53% over the same period last year. Absolutely incredible. And it's nice to see their earnings per share 87 cents above that prior quarter, 0.81. So nice to see. Now when we compare that to the analyst estimates, well, they beat on the top line by 2.25%. And they also beat on the earnings per share of 4.82%. So not only did they beat Wall Street analysts, but they also strongly outperformed the prior year, both on that revenue as well as the earnings per share. So very positive from CP. Now for those who do want to see a bit more details in terms of the different streams, how they performed, you can take a look, pause the video and just run through this on a more detailed level view. So let's take a quick look now at the historical performance of the company. And for those that don't know, when you're looking at the name, in fact, Canadian Pacific and Kansas City Southern combined to create CPKC. Now, they do become the first and only single-line railway connecting Canada, the US, and Mexico. And this was completed in April 2023, so nearly a year ago. Over the last year, they are up around 2%. If we go back to the last 10 years, they are up a fairly strong 165%. Bear in mind, it doesn't include those dividends reinvested, and we can see they haven't really broken out from the all-time highs that they have seen at a few points over the last few years. In terms of where they sit, well, they're in the mid to upper end of the 52-week range. The trailing 12-month yield sits at 0.71%, and their forward PE just under 25. In terms of their revenues, now what we typically like to see, 3 to 7% growth year on year. Well, they reported $6 billion in 2019. 9.5 billion in their latest annual report from December 2023. Strong growth over the last 5 years. In fact, we see 50%, very nice to see. On a more granular level, we do note there was very little movement from 2019 to 2021. It did then increase slightly in 2022, but after that merger, we do see some strong growth, which we do hope over the next few years will propel them to a very strong top-line company in terms of just increasing those revenues year on year. Bottom line, the story that we can see here, 1.9 billion reported in 2019, just under 3 billion. So also growing at a slower rate than their top line, but still some strong growth over the period. And on a more granular level, we do see increases consistently to their bottom line. So that is still positive, even though their top line for the first 3 years of our analysis was fairly stagnant. On the bottom line, they did manage to produce some strong efficiencies. So very nice, very positive to note so far. In terms of the balance sheet, a quick look at total cash versus total debt. 100 million of cash and short-term investments in 2019. 350 from that annual report. So very nice to see they've increased their cash 3.5 times. Now, when we briefly look at that total debt numerically and directionally, what we can see is it has in fact more than doubled, 7 billion to around 17 billion, although we do know some of that does relate to that merger, but still nonetheless it has increased quite significantly at a much greater rate than their cash. Something to bear in mind that we'll touch upon when we look at the net debt to EBITDA metric. Now, for those that don't know, this is in the rail transportation industry. We have some competitors like CSX, Canadian National Railway, Norfolk Southern, and a few others. Now, over the last year, we do see CP is up around 2.6%, including those dividends reinvested, one of the worst performing. Now, when we extend that to the last 5 years, In actual fact, they are the best performing at 105%. And what is also nice to see, given that merger that did take place last year, this does look like it could really propel them to be growing even more over the next few years. But as always though, remember, past performance is never an indicator of future performance. Now, institutional ownership, it does sit at 68%. We see around 5 billion worth of sales in the last 12 months. When we look at the same period, we see 10 million or 10 billion in fact of buying. So essentially more buying than selling, twice as much. Q1 of 23 we see more selling. Q2, Q3 we see more buying. Q4 a little bit more selling. So pretty inconsistent, but as a whole over the last year, more than double buying by these institutions than selling. You can bear that in mind, but again, don't just go off that, do your own due diligence. Insider buying and selling, we have run them through the screener. We have put up to the last year, so there is nothing to note based on this analysis and screener. So that takes us to the dividend safety for Canadian Pacific Kansas City Limited, 76 score. It is safe. Market cap, 75 billion. It is a large cap company. In terms of those recessionary metrics, well, they maintained the dividend in the last recession. Average growth at negative 13%, but bear in mind they did trail the S&P negative 64 to the S&P's negative 55. In terms of dividend growth, well, they haven't increased that dividend since 2020. Over the last 5 years, though, and over the last 20 years, double-digit growth. Just something to bear in mind. They haven't increased that in a few years. And as we can see here, over the last 20 years, they have been paying a dividend without a reduction. In terms of dividend yield theory, it states the company is undervalued when the current yield sits above the 5-year average. We have a sign here of overvaluation, 0.7 versus 0.84, and another sign here, 24.9 on the forward PE versus the 5-year average. But do bear in mind, we don't look at any of these models in isolation. We will draw conclusions towards the end. Industrial sector PE is also lower at 18.3. In terms of the free cash flow payout, below 60% is what I particularly go for. It does give me faith that management are able to offer double-digit increases. Earnings, personally, I do ignore. It is susceptible to manipulation by management through accounting. And what is nice to see, over the last 10 years, it has been below 50%. So that is very, very strong. It is interesting to see whether or not in 2024 they will increase that dividend. Free cash flow per share, yes, it has been increasing, 78 cents to 176. But we do note 2021 and 2022, it was much higher. It did come down, and now we are hoping with that merger that did take place, as we see in 2024, we are expecting nice big things from CP. Hopefully this will translate into the numbers. And we can see that here, the first full year post that acquisition or post the merger, 42% growth to the top line, very, very positive. In fact, even before then, it was still around that 3 to 7% we like, with some years double digit, although we do note 2016 and 2020 negative growth. So numerically, for those that like to see the numbers, they've pretty much doubled their top line from 6.6 billion in 2014 to 12.6. And I would like to think we will now see some very strong growth to their top line moving forwards. In terms of shares outstanding, well, 2014 to 2021, they did, or 2020 in fact, they did do share buybacks, so they did return excess cash to investor pockets. They then issued shares, as we see here, around the time of that acquisition or merger. So therefore, whilst it is understandable, just as a point to note, from 2014 to 2023, the shares outstanding has increased. In terms of the ROIC, personally, 10% or more gives me faith that management are effectively allocating their capital. And when I am looking at management and analysing them, this is a green tick to say, yes, management are performing as I would like them to. The last 3 years, while some people could attain some of that to that merger, it is fairly low. I would like to see 2024, this go back up to the double digits that we saw quite consistently from 2014 to 2019. Operating margin, very strong, above the minimums at 12%, the same with the free cash flow margin. Just note though, the free cash flow margin has come down from 2021 to 2023. Again, just something to keep an eye on, but hopefully it will go back up to those strong high 20% digits we love to see. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Now it makes sense. Well, firstly, this essentially shows us the balance sheet strength and dividend safety, and these are the number of years it would take the company to pay off all of their debt net of cash on hand. Makes sense when they did merge that they do have more debt. It is nice to see that in 2023 they did bring this down to 1.77, below that 3. Do note though, in 2024 it is expected to go up to just under 3, so something I would personally keep an eye on as an investor or a potential investor. So let's jump into the valuation of CP. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, this would be the first model that we use, and now whilst they haven't grown their top line double digits every single year, the last 2 to 3 years, it has been some very strong growth. In 2024 and beyond, I do believe that we will see for CP more double-digit growth, so I will be excluding this model moving forwards for CP. So the first model, multiples valuation, companies in a similar sector and size, we have their PE, the average PE multiplied by the earnings per share to get an intrinsic value of $83. Yes, we have a sign of undervaluation, just under 5% upside, but remember, we're not looking at any of these valuations in isolation. We then have the dividend discount model with the yearly dividends. Now, yes, average growth, it does look very nice, 11%, just something to bear in mind, given this is a Canadian company. We do see the negative here, it does relate to FX. Growth rate moving forwards, we have done 7.25%. Now, I do believe they will start to do those increases that we did see before, where in fact it was double digits. But again, you can be more conservative and argue a lower number. So we see another sign of undervaluation. We then move on to the DCF model with the free cash flow year on year. Moving forwards, average growth rate just under 17%. We have gone for 17. Analysts are expecting higher. With that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, we get another sign of undervaluation. So the intrinsic model for today's episode is just the average of these three, and it is coming to $87.64. As always, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, you can click on that pinned comment below. So margin of safety, we start off with 10%. Remember, we use that if we believe it has a wide moat, strong financial metrics and good forward-looking data. Now, you can argue with CP, given their merger, you may believe them to have a very wide moat. You may believe that to buy them at that price. What I would say is at 10%, around that $78, it isn't too far off the current trading price. So realistically, at this level, we do see around a 10% margin of safety. In terms of what Wall Street forecasts, they see around 16% upside. They see the share price over the next 12 months to $94. Now, my only thoughts with this company are I would like to get them at a much higher margin of safety. I do hold Union Pacific, I hold Canadian National Railway, which are both very strong companies in this industry. Now, whilst this is on my watch list to buy and add to my railroad portfolio allocation, I would be wanting around a 20% margin of safety. And now, while you may never believe it will go to $70, this is what it would take for me personally to execute the trade. Lastly, what I just wanted to point out in terms of the 52-week low, it did hit around $69, so it's not to say that it won't hit that price again. As always, if you did enjoy today's episode, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. I'll see you on the next one, and as always, have a great day.